Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from over 20 years in the game. So you skip the mistakes we made and go straight to property investment success. Jeremy, today Q&A. Haven't done these for a while.
Yeah, let's get into them. There's a few.
Alrighty, so...
You want me to read this one out?
Let's go for it. Go for it.
This is from Gravy Plane. Great video. Always appreciate the content. I've been hearing a lot about the affordability crunch and experts focusing on affordable suburbs for investments. Have you found any links with capital growth and affordability? I think the first step is defining affordability. One definition could be median house price over median income, or from HEMS spare cash, or median house price versus median house price. Alternatively, is there a trend between affordability, capital growth, and cash rate? Do more affordable properties grow less or more during higher borrowing cost periods? A lot in that.
So let's just start with what HEMS is. So it's a household expenditure measure used by the lenders. So pretty much like a minimum living expense benchmark. So for example, let's say you declare $2,800, let's say, for example. Let's say $3,000. That's your living expenses for the month, but the benchmark for the lender might be $4,000. So they work off that for the serviceability. But a lot of lenders have different serviceability calculators. So I think from a personal point of view, you do want to understand, what's your capacity, but more importantly, what are your cash flows like? Is it $1,000 a month? Is it $2,000 a month? Like, what is that surplus? And what can hurt you the most, right? Like, have you already got lending? And the big thing that can change for you, or variability, is if interest rates go up by 1%, let's say you've got $1 million worth of debt, well, that's an extra, $10,000 that you need to find a year in interest. Even though you can claim some of that, whatever it might be, if you've got investment debt. But I think that's the trickiest thing, is trying to find that surplus and then direct it into investments or your super or a share portfolio to try and reach that FIRE goal of retiring early, right? But I think, so this question is really related to cheap and expensive.
Yeah, affordability, and right at the bottom there, I picked up on the do more affordable properties grow less or more during higher borrowing cost periods? So what I did is I charted on the next slide.
Yep, let's go.
So this chart shows the lower priced 10th of the market, that is the cheaper end, the cheaper 10%, versus the higher, more expensive 10%. And then interest rates shown there in white. So the upper end of the market is in purple, the lower end is in turquoise, and the target cash rate is in white. And on the far left, where the data starts, looks like in 1990, the historically high interest rates of that era definitely improved growth for the cheaper end of the market. It looks like that anyway. And in the years following, there was a period of falling interest rates that appears to have benefited the upper end of the market more. But from then on, looks like both ends roughly move together. But there do appear to be less extreme movements in the lower end. So when I first put this chart together, I noticed there was a big boom in the upper decile around the time Sydney was booming from 2012 to 2017. And that might have been because of interest rates or something purely Sydney related. So I partitioned the markets by significant urban area. So the most expensive 10% of the market are the most expensive 10% from every city, not just from most of Sydney. And the cheapest 10% of the market are the cheapest 10% in every city, not just most of Hobart, for example. So, yeah, draw from this chart what you want, but I don't think there's much in it. Affordability is considered by the demand to supply ratio. That's version 3, but it is one of the weakest correlations, and there are quite a few tricks that need to be applied to get it to correlate to growth well enough to be used in the DSR. For example, a simple comparison of incomes versus property values is insufficient to measure affordability in a way that correlates to capital growth.
All righty. So thanks for the question, Gravy Plane. So I guess to summarise that, not much correlation, right?
Not really, no.
We'll go on from Luke Miller. So assuming 4% yields is maintained is a bit of a flaw. Rental growth doesn't keep up with value growth in my view. I'm assuming I'd be keen to see this proven or myth busted in a future episode. This could be a potential expert busting episode.
I think this one was about our estimates for your typical bog standard investment property held over the long term. We had like an estimate for yield, an estimate for capital growth, estimate for expenses. And so the suggestion from Luke is that maintaining a 4% yield is flawed. Well, definitely if you pick a hotspot, the growth will be in the double digit per annum, but rent is unlikely to grow at that rate. So for that period of accelerated growth, assuming 4% yield is, unlikely. But I think the episode in question refers to a long-term hold, not just a few years. So I examined the historical yield data. It's in the next slide.
Yeah, I think the key thing is, like as you said, Jez, if there's a massive growth run, the yield will sort of go down, right? Because the typical value is increasing for that property. But if the property declines and the yield's higher, if the rent stabilizes, so I think you normally go through these periods where you'll get this growth. In recent times, it's been a little bit of both, right? Like property growth and rental growth.
Yeah.
But it's like if constantly you had this yield dropping, well, everyone would just move out of property investing. They couldn't afford it and they'd go somewhere else, right? Like you'd look at an alternative investment.
Yeah, well, let me just, I'll actually come to that, but I just want to explain this chart. So it shows the national median yield for houses, and this is measured only over Australia's significant urban areas. So that's where the majority of real estate is. Now, although it shows a slight downward trend, the period is relatively short, only the last 20 years, and that's as far back as reliable house yield data goes. Now, what I've learned from property is that there can be cycles lasting a very long time. So we don't know if yields are about to go up or if they have further to fall by simply looking at this chart. Now, if yields did continue to drop, it would eventually reach zero. In fact, if you continue the trend, yields will be negative in about 100 years or so. That means landlords would actually be paying tenants to occupy their property. Obviously, not going to happen. Far more likely explanation is that this downward trend is temporary. It will balance out at some stage. So either property growth must slow or rent growth must accelerate. Over these 20 years, landlords have accepted a lower yield because it has been offset by higher growth. And perhaps the next era will be rising rents offsetting lower growth. Or perhaps we've always had a balanced yield and it just changes in line with price growth and landlord expectations. So as investors leave the market, the system responds with lower vacancy. As a result of that, rents climb. And as rents climb, that makes property more appealing for investors and they return to the market, increasing the supply, resulting in balance again. So it all balances out on its own without the need for intervention like it has for centuries before. And that's before we even knew about the law of supply and demand. And we don't need governments mucking and tweaking with it. It all does balance out on its own. So coming back to the question, if yields continue to diminish over the long term, then growth would accelerate and vice versa. So 4% is not a bad assumption, but you can see a downward trend in yields over recent years.
Next question, we've got Kamal. So we've got, hi Damien and Jeremy, thanks for the effort. I want to understand your thoughts on this. I use Suburb Data, which is our research platform, to analyse two markets this way. Bushland Beach, Townsville, and Andergrove in Mackay. Both have MCT, which is our market cycle timing metric, below 20, which indicates sell. But they're growing fast, and the DSR scores for both are around 70, which is above average. The contradictory data points are making me less confident to act on this data. How would you analyze this? Fantastic.
Right. Yeah, get this all the time, particularly in recent years with market cycle timing. Market cycle timing is quite low around the country because we've had so much high capital growth in recent years. All right. So first of all, a low market cycle timing does not indicate a sell. A low DSR indicates a sell. The market cycle timing is just one of many variables that are factored into the demand to supply ratio, and there will always be some variables that contradict the overall score from the DSR. In fact, there has never been a market where every variable points in the same direction. It has never happened. So you're always going to have a contradictory metric. And the more metrics you have, the more you'll get contradicting. So it's more than just one or two that contradict the overall score. So what the DSR does is it considers all the good metrics, all the bad metrics, brings them all together into an overall score. So you might have some metrics that are quite poor, but the majority of metrics will be heading in the good direction if the DSR is good. So keep in mind, however, that the DSR is a score for investment potential over the short term, the next few years. So it might only be 2 years, or it might be stretch as long as 5 or even 6 years, but it is short term. Now, a lower market cycle timing means there has been enough growth in the recent past to suggest the market is not about to boom. That's what a low market cycle timing score means. This market is not about to boom. But it doesn't mean it won't continue to boom if it's already booming. So you can't look at a single variable in isolation. The DSR brings them all together for the most accurate overall assessment of investment potential. But both those markets are good markets to invest in, and the reason why is they have high DSRs. That's how I would analyse this.
And my summary also is that a low MCT does not indicate a sell. Just ensure that just looking at one metric and saying I'm selling it because of this one metric is incorrect. You need to bring your personal circumstances in, work out what your capital gain liability will be if you do sell, what's the alternative market that you're going to be going into. So we've done a lot of this analysis before for clients. So you can reach out to us if it is something that you're pondering about if you should sell, and we will do the analysis, right?
Should I sell analysis?
Should I sell analysis? So we have done them in the past, and sometimes it's a hold, right? Just hold the asset because the capital gain liability is just too large. But back to your point is that low MCT markets could be still booming.
Yes.
And hence why, like I've got market metrics. So for example, for within our platform, we've got Bushland Beach in Queensland, houses for May data, DSR 3 is still above average, typical value around that 818,000, yield of about 4.1%. The data is reliable, vacancy rate strong, rental growth is good, days on market is low. Stock on market, about average. Market cycle timing
high.
low, but the last year is up about 8%. The last 3 years around 58%, and the last 5 years about 82%. So if you bought 5 years ago, you'd be
fantastic.
But it's more about if you're buying an 800K property now, it wouldn't be at the top of my list.
Yeah, unless it was a get in, get out kind of investor. So someone that's quite dynamic and aggressive. So you could get anywhere from 18 months to 3 years of excellent growth, given the DSR is quite high there. But it's more likely closer to
the end,
its peak. Yeah,
and you can just keep an eye on how it's been growing in historical charts. Just keep an eye on the typical value. The other thing is Andergrove, again, DSR 3 is a little bit weaker here at 58. Typical value.
Noticeably. Was that the other market? Let me go to that question. Bushland Beach, Townsville, and Andergrove in Mackay.
Andergrove. So the yield's a lot higher here, statistical reliability. But again, the last 5 years has gone up significantly. But you can see over the last year definitely slowed down at around 6% growth over the last year. But over the last 5 years, 83%. So it's considerably, and that could be indicated in that MCT that market's slowing.
Yeah, so simply because the DSR is higher in Bushland Beach, I'd pick that over Mackay.
Next question. So we got from.
You want me to read it out?
Yeah, go for it.
Who's answering this one? I'm answering. So you read it out.
Well, I'm not sure about who the comments from. Shiravas. Yeah, I can't even read that. 2027. All right. So I'm wondering, how is this different from taking out equity? Okay. So this is, I think, regarding our EBS Expert Busting Series 12. So our series, long-term growth, why short-term wins matter more. So I'm wondering, how is this different from taking out equity after a big growth in market A and then investing in another market A? Why do you suggest selling and then reinvesting in another booming market? I can imagine one reason might be borrowing capacity or serviceability, which would be my situation. But if that's not an issue for someone, how is it different of a better strategy to trade rather than just extracting equity and repeating the process?
Right, yeah, it is a bit tricky, this. So firstly, remember this was recorded before the 12th of May federal budget.
The Expert Busting Series 12 was recorded.
Episode 12. Episode 12, and then we had 12th of May federal budget about those, the announcement about the tax changes. So as indicated in the episode, the reason to sell and not simply draw on that equity is because you would be better off. If you drew on the increased equity and you kept the first property and then bought a second property in, say, some other booming market, then you would have one property growing well, the new one in the new booming market, and one property growing poorly in the market that has peaked. So the idea of selling is to have two properties growing well instead of only one. And that's regardless of whether you are struggling for serviceability or not. Regardless of any lending restrictions, it all comes down to opportunity cost versus the cost of reallocating that equity elsewhere. And that has changed recently with the new CGT laws proposed for 2027. But the analysis remains the same. All you're doing is comparing the opportunity cost, so you're estimating opportunity cost and comparing that with the reallocation of equity cost. So if the opportunity cost is noticeably larger than the cost of reallocating equity, then that's a sell recommendation. So, for example, if you estimated that over the next 5 years you're going to get zero capital growth from the property that you've held, property one, and then you estimate that the replacement property is going to have, over the next 5 years, say 80% capital growth, that is an 80% opportunity cost, 80% of the value of the property. So if it's a $500,000 property, that's a $400,000 opportunity cost. Now, if you calculated that it's going to cost you $150,000 in CGT, agents commission, stamp duty, just to move that equity elsewhere, well, $400,000 is a lot bigger than $150,000, so you would be better off. Now, you can keep the first property, draw on that equity, buy the second property, assuming that there's no restriction on your lending, but you're still going to have one property underperforming, whereas you could have two outperforming. So the answer to the question is because you will be better off if opportunity cost exceeds reallocation of equity cost.
I think the tricky thing here would be you've had this massive gain. So if we look at the example before where we've had 83% growth in a market, and then let's say we've seen it flatline the last 3 years, like it's had its growth, the DSR3 is really weak, let's say 30, it's like, ready to sort of offload this to move to another market. Like if you hold it and it does nothing for the next 5-6 years, you could have that money reallocated in a market that grows 40, 50, 60%. I think that's the key point. On the flip side, if lending isn't an issue, well, you can take that a bit more of a passive approach and just hold it, as long as you sort of understand the risk that, you know, you might not have that significant growth moving forward. But a lot of the time, I think with analysis that we do is that if that capital gain is quite significant, a lot of the time it says just hold the asset because it's just so significant.
Yeah. If you have to pay too much in capital gains tax
And expenses.
So that reallocation of equity, I think that was my right hand.
Yeah.
If that's just too high, then the analysis, the should I sell analysis, comes up to no, don't sell. But I think that where the confusion arises is most investors are thinking, well, I could get 8% growth here or 6% growth there. It's not like that. It's like 18% versus 0.6%. It's a dramatic difference. So markets just don't grow that consistently. Instead, they have massive booms and then very flat periods, possibly even retractions. And so, when you calculate the opportunity cost, it's not like a little 2% difference between this market and that market. It's a huge difference.
Next question from QQQFFF. Love this episode. So this is referring to, I think, again, EBS 12, long-term growth, why short-term wins matter more. Great to see some data and proper research in this area. It definitely let me rethink. One concern, though, say property A has nearly doubled in 3 years and showed signs of flattening. If one sells it with CGT and tries to go into another fast-moving, growing market, is it possible the capital gain is not enough to enter the next growth market? That's the first part of the question. I think we just sort of answered that, didn't we?
Well, first of all, if it's doubled in value, okay. So you've got enough capital gains. If one sells it with CGT and try to go, is there enough? Yeah, well, CGT is not going to cripple you. It's not like the government takes all of it. They can't even take half of it because the highest marginal tax bracket is 47.5 cents in the dollar. Even with these more recent tax changes, you still subtract the indexation of CPI. So you're not going to pay even half of the capital gain. So you will have enough to go into the next market.
But it's going to hurt a lot more, right? So before this federal announcement, it was maybe a lot more ideal to sell and move into another market because let's say you're at that 40%, 47% tax rate, you get the 50% discount, you're sort of just above what? Let's say, what's that, 23.5% roughly?
That's what it used to be.
Yeah, roughly. But now if you're on that highest tax bracket, let's say at 47%, you factor in indexation, let's say 40% capital gain, just as an example, after 1st of July, it's going to hammer you.
Yeah, so the difference there, 23% versus 40%. We're just picking numbers without having a calculator here or spreadsheet or whatever. But that's the difference. But you've still got the lion's share of that CGT that goes into your bank account after tax. Doubling in value in 3 years is phenomenal. You will have enough money to purchase again in the next market. And the next bit is, what if the first market that flattened out for 2 years then picks up again? Wouldn't it be a shame? For example, think of Hobart. Okay, all right. So it's highly unlikely, I think, that if you've seen a market double in the space of 3 years and then it just has a 2-year hiatus, a little breather, before taking off again, I think that's extremely unlikely. I think it's extremely unlikely to see a market double in just 3 years, but then on top of that, to then have a 2-year breather and then go again, more than likely you'd have a 7-8 year breather before it starts off again.
And it's like, are you reallocating all that capital again? So from those proceeds, are you reallocating all of it, only part of it? That's another question too, right? But more than likely going into that better market, it's going to outdo Hobart, for example. Like if you think of Perth as an example over recent times, it's outperformed Hobart, hasn't it?
Yeah. So let's say we were taking the example of you've held a property in Perth for 3 years, you've had tremendous amount of capital growth. Are you wondering then whether to sell the one in Perth and buy again in, say, Hobart? I mean, that's if Hobart was about to boom. I wouldn't be betting on that as much as, say, for example, Darwin right now. And even right now, probably not a good time to sell in Perth because Perth is still running quite hot. But the theoretical question is, if a market is reaching its peak, should you then exit that market and buy in the next booming market? And even with capital gains considered, it really does, well, it all comes down to that opportunity cost I was talking about before versus reallocation of equity cost. So somehow you need to be able to forecast the capital growth of the property you're considering selling, forecast the capital growth of the property you're considering purchasing, measure that difference and see if that difference is bigger than the cost to move your equity out of the first property into the second.
And I think a lot of the time, though, as we know, like if that has doubled in 3 years, we know that should I sell analysis more than likely is going to say hold. If that capital gain is that large, it's highly likely.
Doubling is quite significant, yeah. But what if the forecast was, say, negative growth? Or,
true.
And there was another market that had a DSR of 88 and we were forecasting that doubling in 3 years.
I think you have to do some more analysis on this to make a call, right?
Yeah, it's a real case-by-case basis. And that example we gave where we were comparing, say, what was it, roughly 23% versus 40%, that was assuming you held a property in your own name. If it's in your self-managed super fund, for example, then it'd be a no-brainer because you're probably only paying CGT at, say, 10%. And there could be other differences too. You'd need to speak to your accountant. But it really is a case-by-case.
And the last part of the question is, another question is, if this method has different implications on exit strategies, when it's time to clear the debts. When is it time to clear the debts?
Another question is if this method has different implications on exit strategies. Yeah, I don't know how to
maybe
answer
when
that.
it is time to clear the debts. I'm not sure.
So is it like nearing retirement?
Potentially. I think this is another thing with these proposed CGT changes is I think a lot of investors maybe were planning, let's say they want to try and retire a little bit earlier before 60 and maybe sell down in a year where their taxable income was going to be lower. But if you start accumulating after that sort of 1st of July 2027, if these changes get passed through, it's that at a minimum, like with the indexation, it's going to be 30%, right? Like a 30% whack, where before, if you were, let's say, you sold in a year where you weren't working or took a year off, let's say that first 20 grand's pretty much tax-free, right?
Yeah.
Or even if you 40, 50, so your tax liability would have been a lot lower. So I think, especially for share investors where they sort of like to sell their share allocations in little blocks potentially to fund their lifestyle, and they were using that as a strategy, it's really going to hurt.
You can't sell off a partial.
No, look, I think a lot of investors, a part of their strategy is like they might want to reduce their workload, right? Like work 2 days a week, 3 days a week, maybe part year potentially. So they've got enough to fund their lifestyle, fund their investments, and then maybe when they get to 60, they start drawing down into a pension phase tax-free within their super fund. So they've built up that nest egg there anyway. It's just about bridging that gap from now to retirement. Like what's your window? Is it 5 years? Is it 10 years? 50? And everyone's strategy is different, right? Like some people want that big owner-occupier home. A lot of people want to spend 20, 30 grand on holidays every year. People might want that flashy car. Like everyone is different. And this is why we're looking at building a strategy tool. I'm doing that anyway. And I'm very focused on like bring it back to yourself first and then work out money in, money out, look at your portfolio on an ongoing basis. And clearing the debt's the interesting one because it's like, I know some strategies are you make all this money, you sell one property, pay off the debt on the others and live off the rental income. But it's that capital gain liability. Like, do you want to get hit with it now or not? And look, I think, maybe some people might be selling down before this 1st of July potentially. Sell off a property with their capital gain liability potentially that little bit lower. Who knows?
It's a little hard for us to give sort of precise estimates given how much these tax changes are still up in the air.
I think everyone's different and everyone's strategy is different. And this is why you need, you can talk to AI and ask questions. Like I've done it plenty of times, with my experience, and you just, you can sort of put it all together and you can do your own numbers and your own cash flows. But the selling one's, I think, a big one. And you can talk to us, reach out if you got any questions around that. And another thing is a lot of people might want to sell their investment that's had good gain and pay off their owner-occupied mortgage.
Yeah.
Like if a market's slowed down, they might not want to go buy another investment property. Now they might go, you know what, I'm just going to pay off the home and reduce that expense. So next question we've got from LR59545. Super interesting. So sell Perth and rotate once this upswing ends would be the right strategy. What was this? Oh, this was for apples and oranges and the ripple effect.
Right. Episode number 11 in the Expert Busting series was titled Apples and Oranges. Okay, so sell Perth and rotate once this upswing is. Yes, but considering these new CGT laws and opportunity costs, like we were saying. Yeah.
I think, obviously like Perth is an SUA, like the DSR3 is strong. The typical value is obviously a lot higher because it's had a massive run. It like doubled the last 5 years. So even the last year, it's up 25%, but market cycle timing's really low. And it's been low for a while, but still pushing along, right?
Yeah, still some momentum there from demand.
Vacancy rates are pretty tight. Data's pretty reliable. And yields are quite good at that sort of 3.9%. So again, if you're going to look to rotate it, you'd sort of wait till it slows down a little bit more. So it's really pushed that last year. The last 3 years, 72%.
Yeah, so don't sell out of Perth just yet is the key message. But even when it does come time for that market to peak or just level off, you need to consider where else could you go, and you need to consider your CGT liability.
Yeah, your personal circumstances. We've got DJZJ1. Hey guys, a little bit confused because if you are to buy in a landfill area of a new estate, as an example, Lake Treeby in Perth, 3-4 years ago, you could buy land around 350, which is now priced at 600, and House of Land is around House and Land is around $1 million. So isn't it actually a good thing from an investment point of view to get in early and hold for at least 10 years to capture the growth? All
right. So I think, this one was about where we were talking about proximity to vacant land. Now, supply is the enemy of capital growth. Demand is its friend. Supply is the enemy. It is not impossible to have an area with high supply, but even higher demand. The problem with the new estates is twofold. First of all, they are usually near vacant land. That can be developed, adding to supply, potentially for years into the future. And the second issue is they usually have very low land to asset ratio. So the land to asset ratio is the number of dollars that you spent on the land for buying this property versus the overall asset. So let's say you bought a property for $600,000 and the land was valued at $200,000. 2 into 6 goes 33%. So that's a land to asset ratio of 0.33, which is very low. So if it was something as low as 0.5, I wouldn't touch it. It's the land that appreciates, the building depreciates. So to get more capital growth, you need more of your dollars allocated towards something that's going to appreciate, land, relative to the overall price of the property. So taking that $600,000 case, you'd probably want the land to be worth $400,000 and the dwelling to be only worth about $200,000. That's a 67% land to asset ratio. So this is the problem with these new greenfield estates. Also, getting in early, that's great in hindsight, but there are just as many stories of little to no growth after the purchase as there are stories of the land doubling in value over the next however many years. And also, regarding holding for 10 years, you're assuming the growth takes place consistently over those 10 years. Instead, the majority of growth happens in a much shorter period of time, like 2, 3, 4 years, and then the remaining 6, 7 years, it's probably flat. So what we're talking about is steering clear of the vacant land, because as a general rule, it's a bad thing. Now, people will say, yeah, but so all right. So you've given this case of Treeby where prices have gone from 350,000 to 600,000. That's great. What's the general rule for playing the lottery? The general rule is you play, you lose. Oh, but Jeremy, there are people who have won. Yeah, that's fine. But what we're using is all these general rules, put them all together and increase your chances of having an outperforming property. And being near vacant land is going against one of those general rules. That's not to say there isn't an exception. But I'll bet, well, I wonder if Treeby might not be a pure greenfield estate. I don't know. I don't think it's Lake Treeby, is it? It's just Treeby?
I think so. I was going to have a look, actually, if it is Lake Treeby. But I'd look at Treeby here. I don't know if Lake Treeby is a we'll have to double check it. But yeah, Treeby here, these are the stats. Okay. So it's had a big run. But I don't know if Lake Treeby is an actual suburb. I'll have to double check it.
All right, so it's had 77% growth in the last 3 years and nearly 90% growth in the last 5 years. So let's compare that to Perth.
I think we had Perth there before, didn't we? Perth.
So it's had 100% growth in the last 5 years. Okay, so Treeby, it's had some good growth. It's outperformed other markets like Sydney, Melbourne over that period of time, but it has not outperformed Perth. So there's a good example of how proximity to vacant land can hurt your capital growth.
Yeah, so you'd still get capital growth, but like I said, there might be a couple suburbs away where you could have got in a similar price point, a little bit cheaper, and you're getting more of that land component. And look, maybe the owner-occupiers prefer living in a brand new house on the smaller block. But again, we find value in the land, especially if it's an investment. But look, stock on market's pretty tight there. In a lot of these estate areas, you'll see that stock on market percentage number be a lot higher. So at the moment, it's a tightly held.
Do you want to look at the bring up realestate.com.au and check the I just want to see the block sizes.
Yeah, let's just
for houses that have sold recently in Treeby.
Yeah, so it's okay. Yep. So we'll have a look at realestate.com. Treeby, got it. Perfect. All right. So this is recent. So we've got like 100
Well, that looks like a townhouse, doesn't it?
It does. It's like
what about a standalone?
177 square meters, 960,000, 1.38 million for 450 square meters, 1.1 million for 313 square meters.
313 square meters.
You've got 313 square meters. You've got $1 million. So yeah, really small, like pretty much new properties, right?
Yeah, so I'm guessing that a lot of the cost of those properties is in the dwelling, not so much in the block of land. But even if it is, it's a tiny block of land to be that expensive.
Yeah, you can sort of see here too, right? Like they're just
a townhouse.
Yeah, it's like the 1.2. So yeah, you're definitely
under 400
paying premiums, right? And if you look at a market like, let's just say, and look, I've never been. I'm just looking at it from a data perspective. But if you look at maybe maybe Gosnells, I just had a look at that earlier before. Gosnells, and you look at the difference, 710 square meters for 730. So like it could be opportunities there potentially if you're looking to buy in those specific markets. Like you're looking at the difference, right? Like 1.2, 1.1 million, but you're getting double the block size. And look, they might be fixer-uppers or renovators or whatever it might be. But there's always sort of options as an investor.
Yeah, so with older houses, larger blocks, you're paying more for the land, you get a higher land asset ratio, and that means better capital growth. So although, yes, you could have had, if you had the hindsight to buy into one of those greenfield estates, you're still suffering from faster rates of depreciation, smaller land asset ratios, and vacant land that's going to be developed, adding to more supply into the future. And the example that you've given, Treeby, has actually underperformed Perth over the last 5 years.
Beautiful. So we'll look to do more Q&A. So if you've got more questions, leave them in the comments section. Jeremy, where can listeners go for more resources?
I don't know. You can look at the expert busting series. You can let us know with your comments if this is the sort of questions that you want answered. And subscribe when you want to be notified of the next episode.
Just subscribe. Like I said, leave comments if there's any. We'll look to do some more Q&A sessions, or if you want to see sort of any metrics or data. We're obviously going to be doing more updates to the platform coming up. So, and we'll be doing updates. We'll be sending emails out about that too. So, subscribe, like, share to the world. Everyone, thanks for tuning in, and see you in our next episode. Bye for now and take care. Thanks for watching.